It's simple. Warren Buffett says it clearly in his book. It's buy low, sell high. So I'm buying low and selling high. It's really simple for me. Warren Buffett knows what he's talking about.
Don't you mean Warren Buffett?
All right, it's May 31st, 2020, and for the third episode of the Richuation Room, we have Moki Finance on to talk to us today. Obviously, he is a investor. He's a YouTube creator, which I want to get into a little bit today, and he also is a personal finance educator. So we're going to get into all three of those things and just kind of see where the conversation leads us. But thanks for coming on today.
Yeah, for sure, man. Thanks for having me on this beautiful Sunday, and ready to talk some personal finance and investing, and hopefully get everyone educated.
And that's what it's all about. Kind of starting off while getting people a little bit more familiar with your backstory, and maybe even get into a little bit about what led you to being interested in personal finance, because in the small personal finance or investing bubble that YouTube and Twitter and that kind of thing can be, the vast majority of the population is not too smart on it. So if you wouldn't mind kind of going into as much or as little detail on your background, kind of what got to you to where you are today, and what got you interested in that kind of stuff.
Yeah, absolutely. I think I have a unique story to share. My background's a little bit different than most. I was born in Yugoslavia, or the former country of Yugoslavia in Eastern Europe, and it was a communist country where, really nobody was getting ahead financially. And in the the early 1990s, there was a big civil war there, and my family came to the United States as war refugees in 1997 to really start over and gain that, or search for that American dream. So when we got here, we had nothing but two bags in our hands. And, I was not a baby, I was 8 years old, but, pretty young kid. And we settled here in Chicago, my parents worked minimum wage jobs and kind of grew up in a rough community. But really the reason they came here was for me. They wanted me to better myself financially, get an education, and, live out the American dream. So, my early years in finance, the only thing I knew about finance was saving money, because my parents were hoarders of cash. They came from a country where, you couldn't make it. So all they taught me was get a good credit score and save cash. So after I graduated college, I got a business degree and kind of graduated at a bad time right after the economic crash of 28, 29. I realized, well, can't really get a good job that pays decent with this college degree, because everybody that I was competing with was already kind of experienced. They already had 10, 15 years and they got laid off or whatever when the big financial crash happened. So I realized, well, I'm not going to make it big with this degree, pretty much, competing with everybody else. So I decided to get my Class A CDL license and go drive a truck. Kind of followed the money. And that was the first time in my life that I made any decent amount of money. I worked all throughout high school and college, retail jobs and things like that. But that's when I finally started making some big money and started spending big money too. Was really in love with debt. I financed brand new cars, brand new motorcycles, had credit cards to go on vacation, all that good stuff. And all that kind of came to a melting point once I got married. My wife had quite a bit of student loan debt, and we finally realized we're in big trouble. And I think most of Americans now can relate to that, because the student loan crisis is out of control. Everybody's got a loan on their car. Everybody's got a credit card. And, it's something that I became passionate about in 2017 when I got laid off from my job. And I realized, holy cow, how am I going to pay this next bill? Because I don't have an income coming in, at least from my side. And it kind of started to open my eyes to the personal finance world. And I'll kind of touch on later on when I started working in banking, how it really started. But that's kind of the background and the backstory up to about 2015 for me, and how everything worked out financially.
That's awesome. And it is interesting. The more people I talk to, the more people I hear stories where they get themselves into debt. And then it's almost like it took that happening to them for them to kind of turn the switch and make a change. And do you remember? Obviously, you said it kind of happened after you got married, but do you remember one instance where, one indication where you're like, I need to make a change, and this isn't the way to go about doing this?
Yeah, I think, that the period in after I got out of trucking and I went back to the regular workforce, I was had a construction management job and I was making six figures and I was making good money. But in 2017 in the summer, I got laid off, and I kind of remember me and my wife sitting at the dining room table, and she was crying over her student loans because our payment was like almost $1,000 a month. That was more than my mortgage at the time. And as a man, and sort of, I don't know, it just, the way it angered me, and it made me feel like, all right, this is not the way I want to live my life. I don't want to have these financial troubles and have it ruin my marriage, because I think a lot of the stuff that, as far as marriages go, finance is important, especially having your spouse on the same page, because that's, you can have all the great stuff in the fluffy relationship, but if you're having money problems, all that goes down the drain. So that was the point where I was like, all right, I don't want this to control me. I don't want this to rule me. And I always had a good sort of, not a background in finance, but having a business degree, I knew finance, I knew numbers. And from there, it just kind of snowballed into where I'm at today.
Awesome. And if you wouldn't mind, if you're comfortable, where are you in terms of that debt and that kind of stuff now?
Yeah, so I started, and I don't know if you're familiar with Dave Ramsey, but I started
Mhm.
learning about Dave Ramsey in about 2018, in the summer of 2018. At the time when I started this, I had $87,000 of consumer debt. We paid all of that off by June of 2019, so we're completely debt free now. The student loans are gone, the car loans are gone, the credit cards are the credit cards are gone. I haven't used a credit card in about a year and a half now. So the only thing I have left right now is $52,000 on my home, which is worth closer to about 180,000. So I'm pretty happy with that kind of equity position. I'm not in a hurry to pay that off, but yeah, debt free right now, loving life. Haven't had those tough tables or tough conversations at the dining room table lately. It's been all about, what trip are we going to go on, and what are we going to do next with our life.
Yeah, that's an awesome feeling. And that's unfortunately the story that you were telling in the beginning tends to be a story a lot of people go through, but they never turn the corner. It just becomes part of their everyday life.
Exactly. I think the mentality of it is you have to get angry, you have to get pissed off, you have to, uh, you know, look at yourself. And I think the biggest problem I had, I blamed everybody else around me. I blamed society for putting me in this mess. But when I finally took control and I said, okay, no, 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 nobody did this to me. I did this to me, and I'm the only person who can work out of this. I created the mess, and I'm going to get out of the mess. So taking responsibility for what the position you're in. You can blame everybody else, but look at my background. I came from a war-torn country. I grew up in a really rough part of Chicago where, there was gang shootings almost every day, and I could have used that and said, I'm never going to make it. We're just always going to be lower class. But I didn't let that kind of stuff hold me back, and I had a bigger vision for life and kind of put the control in my hands.
That's awesome. That's the stories you like hearing. And now you have kind of taken that those lessons learned, and you've turned it into a YouTube from my guess about half a year ago. Is that correct?
Yeah, that's correct. So really what's inspired the YouTube channel is I thought, I have a story to share. I always loved watching YouTube, and I watched all the big YouTubers like Graham Stephan and Andre Jick and Bruce Wayne, Joseph Carlson, all those guys that kind of talk about personal finance. But I felt like, to me, they weren't relatable because they're guys that are showing you, like in Graham Stephan's case, net worth of 5-6 million, or Andre Jick, who's got $150,000 portfolio. And for the average person, you might see that and you're going to go, well, I'm never going to make it there. It goes back to that mentality of, the little man can't get ahead, and you can't even picture yourself with $150,000. So I got this idea to start a YouTube channel where I kind of show the world. I start from zero. You can go back to like my first video in November. I had $0 in my M1 Finance portfolio. I strictly created that portfolio from zero to, my goal is to get it to $1 million. And right now we're sitting at, I think, just a little bit over 10,000 in 6 months or 6.5 months. It's something that I feel like a lot of people, I'm not saying go watch it and copy what I'm doing. In the beginning, I showed a lot of different strategies, but I wanted to just show people that it's possible and this is how it's done. It's easy to open this, a YouTube video and see $150,000, but it really doesn't tell you how that person got there. Versus, you can watch every single week that I make a deposit, that I make a buy, and you can see kind of what I'm doing and what strategy I'm focusing on.
Yeah, and learn some of those lessons learned that you've acquired kind of throughout video to video as well. And I think the interesting thing when you see these guys with huge portfolios, it's inspiring because it gives you the hope that hopefully you can have that someday, and especially when there are guys that just have, whether it be average jobs and they're just extreme savers or whatever the case is. But it is difficult in the beginning because you're looking at your small portfolio, whatever you're starting out with. You're like, I'm never gonna have that. But something I was actually talking about yesterday, I think I was on Twitter, and I was just talking about the quick money grab. Obviously, is very enticing, right? If you can make one trade or whatever the case is, and make a huge return of a couple $100,000 or whatever, that's obviously very enticing, and nobody would turn that down. But at the end of that, it's not going to be nearly as beneficial, and you're not going to look back on it with the same kind of prowess and proudness that you would if you built this thing from zero up until a million, even if that is 10, 20, 30 years from now.
Yeah, absolutely. So I kind of got a story to share on that. When I first started, I'm sure you guys and everybody else sees these ads on YouTube, guys in their Ferraris and their big mansions, and they're talking about, this one trick to get you to become a millionaire and you only need $1,000 or whatever. That's a pipe dream. That's somebody who's going to be selling you a course, who's going to be basically scamming you at the end of the day. I think investing is a long-term game. You have to be patient, but with anything in life, I think you have to be patient. You have to be smart. But as far as the type of investing I did early on, it was that I was chasing that big gain. And I remember in 2019, kind of, I was still paying off debt, but I was almost done, and I had this extra $1,000, and I opened a Robinhood account, and the free stock that I got on there was Apple. At the time, Apple was trading at like $140 or something like that. So I took the $1,000, I put another thousand. I'm sorry, I deposited $1,000, and I bought, I think it was like 7 shares of Apple, plus I got the free share, and I ended up selling a little bit later. I don't know if it was like 8 or 10 months, but the price was damn double. It was like 310 or 315. And, I doubled my money, and then I went from there and started looking for other kind of stocks to do that with. But I quickly realized it's a loser's game, and something that I've been inspired by in investing. And I think my biggest kind of inspiration was Jack Bogle. And the first book I ever read was the Little Common Sense book on investing. And he talked about, investing in index funds or broad-based funds, and how it was the best way to get the most consistent return. Because when you think about investing, it's really what return are you getting over the next 15, 20 years, not necessarily what return you're getting in the next month, because that doesn't matter. So I made some money doing kind of that day trading, swing trading type of deal, but I lost some money. I lost almost all of it. And I realized, this is not going to be a long-term solution for me. And I kind of got out of that. And that's where I kind of transitioned into dividend growth investing and what I do now. But primarily, still to this day, I would say 90% I buy broad-based index funds, whether it's the S&P 500 or it's the total stock market, because I don't want to look for that needle in the haystack. I don't want to be searching for the next big thing and dumping a lot of money into it, because there's way too much risk involved. And even, for example, in my M1 Finance, where I do individual stocks, I try to limit that exposure to about 5 to 8% of my overall portfolio is in individual stocks, because as we've seen over time and time again, and history proves this, you look at a company like Sears, for example. There were a king in the S&P 500 not that long ago, and who's Sears today? So you're really, picking individual stocks, and there's data on this right now that I think the average tenure of a company in the S&P 500 is about 30 years. And they project that in the next 10 to 15 years, with all these, tech disruptive companies, it's going to be even less. Look at some of the big market cap companies like Amazon, Google, Apple. Those companies didn't exist 20, 30 years ago. So I think index funds are the best way to go for a beginner investor, an intermediate investor, and even a long-term investor. And you should definitely be staying away from those get-rich-quick schemes and the promises of $1 million, because your chance of doing that is probably 1 in 1 billion.
Yeah, and it's funny, you're the third guest I've had on, and I think both Casey Burns and Matt Money, and I mentioned it also, said the same exact thing, that if somebody's trying to sell you a course, it's probably not going to be very beneficial for you. And it's so easy
Yeah,
to get
exactly.
it's so easy to get enamored by, like you said, the Ferraris and the mansions, even though they probably rented both of those for the video. That that
Yeah.
when you don't know anything, you're like, well, why wouldn't I believe this guy? He's showing me these returns, and why wouldn't I try it for myself? So I went down a similar road, but kind of like you. Luckily, I didn't blow up any accounts or go into debt over it. And some people have crazy stories where they get addicted like it's gambling. So thankfully, we both saw the light before any of that popped up.
Yeah. And I think just one quick wrap up point on that. I follow on Reddit Wall Street Bets. I think they became pretty popular recently, but some of the things those guys are doing. Again, it goes back to the risk versus reward thing. They're young kids who are willing to risk it all, with really no long term approach to it. They just want to get rich quick. And uh, history, even if you look at people that have come into money, like lottery winners, I think the statistic is like 78% of them or something like that file for bankruptcy within 5 years of winning millions of dollars, because they don't know how to work with money. They're aspiring to get it, but once they get it, they blow it all, and they go back to where they were before. So yeah, a big warning to new investors: stay away. I would say stay away from any kind of risky investments throughout your entire life if you can. It's always fun to speculate on stuff. I still speculate to this day, and I throw in a few $100, but that 100 or 200 is really, I don't want to make it seem like $100 is chump change, but it really is. It's whether I go out and have a few drinks, or I take $100 and I put it into a speculative play. That's how it is for me. But anything more than that, I think, yeah, the risk versus reward is way too
For
high.
sure. I saw a quote recently that said, if you can't manage $1,000, you can't manage $1 million. So those
So true.
those lottery winners are,
So
I
true.
doubt they were managing their money very well prior to that if they're losing millions of dollars quickly after that.
Yeah, exactly. And kind of talking on lottery winners, this is where I just want to segue to something I do as far as my side hustle, which is I do financial coaching. And I got the idea and I got inspired after I paid off the debt. But really what I did is I printed up some business cards and flyers, and I went to the gas stations, and anybody I saw by the lottery machine, I would give them a flyer and my business card, and I would say, you're dumping the whatever $200 a week in that. Give me a call. I'll be more than happy to help you and teach you how to invest your money where your money is going to go to work for you, versus you just kind of throwing it in this machine and scratching away for the rest of your life. Because those people are pretty consistent when it comes to playing the lottery. And I had this idea, well, I can turn them and make them consistent investors or savers, where I can show them, hey, this is what your money can do for you. So that's kind of where I got started with the financial coaching. Not a lot of them have called me back, unfortunately, though. I think I realized, these people are not that they're so much interested in making money; they're almost addicted.
Yeah.
It's an addiction, and it's not something that's easy to change.
Yeah, it's just like we talked about with day trading or penny stocks. You see, I'm sure they've heard of one person that bought a lottery ticket and made millions or a couple 100,000, and they think it could be them, and it could be, but the odds are definitely not in their favor.
Exactly. Yeah. I mean, I don't want to say, if you play the lottery, you're bad, or if you gamble, you're bad, but you got to look at the numbers. It always comes down to the numbers and what are your chances. And when I look at the numbers, my best chance of building wealth is the S&P 500 or the total stock market, because there's no 10-year period in history since its existence that it's been negative. So, it goes up over time, and it's something that I feel safe. I feel like it's safe enough that I could put my money in there, especially as a long-term investor, and I don't have to worry about any of the short-term risks, because there is short-term risks, right? Like as we saw, in February or late February, early March of this year, where the stock market plummeted 20%. Those risks are real, right? But if you're long on everything in your portfolio, if you're not needing the money, if you got your debt squared away, if you have your emergency fund, why should that matter to you? It shouldn't. Sometimes I uh, I over analyze things, and this is one of the another tips here for new investors is don't check your account every minute and see, what the stock price is of whatever stock you own, or what the price is of your index fund, because you're going to go crazy. You're going to, make some decisions based off emotions, based off, what you're feeling. You might panic or scare yourself out of the market, and you might jump back in at a bad time. And again, this is going back to why I'm not a huge fan of individual stocks, is because people buy those on emotion. People realize that, okay, that whole FOMO, or fear of missing out, a stock is like Tesla, for example, right? Tesla rode up, when was it? End of maybe December, where it's trading around 350. And then, you saw that stock price jump past 900, and everybody was asking me about Tesla. And I was playing Tesla. I bought a few shares in November, I think for an average of 340. And I rode it all the way up, and I ended up selling it at like around 790, those 3 shares, and made a decent profit. But I think, what I was telling people that were asking me about it, I said, you got to be very careful. This is a stock with crazy volume. It's going to be so volatile that most everybody that tries to play that game is going to lose, right? There's only going to be very few people that are going to make money with Tesla. And as we saw, all the people that shorted the stock lost a lot of money. These hedge fund guys lost millions and millions of dollars. And at the end of the day, that was all based off emotion. There was no reality check there for people to be like, okay, maybe I should stay out of this. Maybe I shouldn't put my hard-earned money into this, because you might lose it all. And I think that's what we see every day with people that are doing this. They're buying stuff at all-time highs, for example, and then it crashes 20%. They're selling. And I'm going, and I have people calling me all the time, friends and family, that, oh, should I buy now? Is this a good time to buy? And I say, yeah, it's down 20%. You got some deals out here, but it's just a matter of, can you stomach another 20%? Because I don't know how low it's going to go. Nobody knows. And that's kind of what makes investing fun, but it's also where a lot of people get burned, is the emotional side of it. And whether it's personal finance and paying off debt, that's all emotions too. You can have your spreadsheets and your numbers down, but if you're not emotionally and mentally ready to do it, you're going to fail. And same thing in investing. If you can't stomach a negative return of 20% in a couple of months, and you can't envision that portfolio ever going back in the green, you're going to fail. For me, anytime I see a crash, I get excited. As a dividend growth investor, I know two things are happening when the market crashes. One, my yield on cost is going up, so that means every stock I buy from that point forward is going to pay me a higher dividend yield. And two, I'm lowering my average share price to lower my cost basis, so that when the market does recover, I'm getting that compound growth. But it's hard for people to kind of grasp that idea, because everybody's talking about returns, right? Everybody wants to talk about, I'm up 50%, I'm up 100%, but I think those returns don't matter as much as the dividends growing and compounding long term.
Yeah, totally agree. And a lot of the things you talked about there is totally based off of time frame, right? So I know a lot of people that jumped into Tesla in the 900s or the high 800s back in late 2019, and then it dropped, and a few of them sold because they were scared. And I always wanted to get into Tesla, so I think I bought it in late or early March at around 700-ish mark. And then, but I was dollar cost averaging, and luckily I got to follow it all the way down to when it hit, I don't know, what was it, 400 or something like that.
400, yeah.
So
yeah, somewhere around there.
But I also have a very long-term outlook for Tesla. I don't need that money now, and the goal is a 10-year, 20-year play, or something like that as it's changing. And I want to get into that a little bit more later, because I know you made a few videos on Tesla and Nikola, and and in terms of the index funds and that kind of thing, totally agree that the vast majority of people should probably be just going for index funds. And it's funny because I have my Roth IRA in Vanguard index funds, and then my portfolio. I have a dividend growth portfolio and a just growth stock portfolio. And I'm truly curious to see 20 years down the line which one did better. And I can almost tell you that my Roth IRA is going to do better because I'm just dollar cost averaging and not really trying to time anything. But I do like and enjoy being a little bit more involved. So I'm kind of taking that maybe 1.5%, 2% hit of compounding interest in the other one, just because I do like kind of having my hand in individual stocks and being able to keep track of those.
Absolutely. I mean, that's a great strategy. I think long term for sure. There's no way you're going to, dollar cost averaging into index funds is the way to go. We all know that. I think, and if you look at returns from that, it's the best way to go. Now, individual stocks have the potential of beating the market. You have companies that you can find at a great discount that are good companies, and kind of using the strategy of buying the dip in individual stocks, you could probably outperform the market. But long term, I think it's very difficult, and studies will show even some of the best investors. Warren Buffett says I think 10% of hedge fund managers can beat the S&P 500 in a 10-year time frame. I think it goes down to like 2 or 3% in a 15 or 20-year time frame. So, and these are professionals, right? These are people that wake up, they breathe, they live this is their life. For someone like the individual investor, maybe like me and you, this might be a hobby and this might be a passion of ours, but think of people who have no idea about investing. What are their chances, right? It goes back to those people that are kind of playing those lottery tickets. In my opinion, I think you have a very slim chance of being successful. And then when you put the emotions back in, and it's so important to talk about the emotions because that's real. It's real. Losing money on paper or on the screen is real to a lot of people. So when you put the emotions back in, it even lowers the return. So I think I was reading an article, the average retail investor's return over a time frame of 10 years is about 2%. So think about that. You can put right now, well, not right now because the interest rates have been cut quite a bit, but before you could put 2% in a money market, put $1,000 in a money market account and earn 2%, right? And you're kind of staying flat with inflation. You're not going anywhere, but you're treading water. And that's what the individual retail investors doing. They're treading water because they're making these trades. They're day trading, they're swing trading, they're all over the place. They're not dollar cost averaging. They're buying high, selling low, and it's really a loser's game. But I like the idea of having an index fund portfolio for retirement accounts. I think that's the way to go, where you dollar cost average, and then kind of having a little bit of a different approach, whether it's with growth stocks or dividend stocks, with your personal or taxable accounts, because it's fun. It's fun trying to beat the market. And it's also not just that it's fun, you can see dividends working, or even in the case of growth stocks, you can see growth stocks outperforming the S&P 500. There's plenty of funds and stocks that outperform the S&P 500 long term. It's hard to find them and buy them at the time, when they're performing really well. But for example, right now, Fidelity has a growth stock, a large cap growth stock that hasn't been negative year to date. While the S&P is down like 6%, the growth stock's up like 8%, right? But that's if you invested in it before the crash. Who had that kind of vision to buy into it? Part of it's luck. Part of it also is, buying and holding that growth stock over time. It's not going to probably outperform the S&P 500 because it's going to be a little more volatile. It's more tech heavy. Right now, tech's doing really great, and the energy sector and the retail sector have been hurt. But, the stock market has a funny way of kind of adjusting itself. It wasn't always where tech was king. There was a time where oil was king, and now oil's basically starting to get wiped out of the S&P 500. It's one of the lowest weighted sectors in the S&P 500. So, again, it's fun trying to beat the stock market, but I think at the end of the day, just buy the stock market. Why do you want to play around and take all this additional risks for a few pennies earned or gained? But if it's something you're passionate about, absolutely, there's nothing wrong with individual stocks. But if you don't have the knowledge of looking at a financial sheet and breaking down revenues and cash flow and understanding dividend payout ratios and understanding PE ratios, I think you probably should have no business playing around with individual stocks, because you're really doing nothing more than speculating and gambling.
Yeah, and I think another trend that I tend to see is people that buy individual stocks, but they're not spending the time to really understand what they're doing. They're probably not buying blue chip stocks. They're hearing something about some company that's going to go up in value because they're making masks for coronavirus. So they're going to buy that on the hope of riding it up. And guess what? Those are probably the stocks that aren't going to perform well in the long term. So it is kind of funny to see that correlation.
Oh yeah, and I think even like you're mentioning here, you're doing some kind of small cap or mid cap play there. Even if you go with blue chip individual stocks, they're not as risky, but they're still risky enough. But kind of one stock that I don't know if we want to talk about that later, but VTIQ or Nikola Motors is one of those speculative plays that I've kind of jumped on their bandwagon. And the reason I did that is, one, I used to be a former truck driver, so I kind of have a little bit of experience in the semi-truck world. But two, it's almost like you see the future, you can envision what they're trying to accomplish. You're like, okay, well, this might be something that not maybe 5 years from now is going to be worth a lot, but 10, 15, 20 years, this might be the future. So yeah, it's okay to spec on that. But if you're speculating on short term, somebody making ventilators or masks for the next 6 months, well, that company is not going to be very profitable once this, whole pandemic is over. That company really is, what are they going to do? So, investing in those, I see those penny traders where they're talking about, these healthcare companies and developing this, developing that, the stock price is $1, it might be worth $100. Well, it's very risky. It's very risky. And I would definitely advise everyone to stay away from that. Again, it's your money. You could do whatever you want, but there's no profit in that. Trust me. Been down that road, been burned many times, and there's definitely no, it's a hard lesson to learn. Maybe some people need to learn it. They need to actually try it and learn that there's no money in that. But I think it's important to listen to people who have done it and listen to their stories and understand, they've been there, done that. They're sharing their knowledge for free. It doesn't cost you anything to hear this, but at the same time, the value that there is in this message of don't get burned is huge. And if you're a brand new investor listening right now and you want to get in the stock market, look at those index funds. Stay away from small cap anything.
Yeah, and guess what? There's probably not any thriving YouTube channels about the guy that blew up a $200,000 account day trading. So the only ones you're really going to find are the guys that are successful. We kind of touched on it a little bit.
Exactly.
We kind of touched on it a little bit, and I know you have a really good video that kind of summarizes it, so people can check that out. But if you wouldn't mind, really quickly, kind of going into what you see with Nikola Motors and what they're doing differently, because I think a lot of people, myself included, when I first heard about it, I was like, oh, it's a competitor to Tesla, but they're really not, from what I can tell. It kind of seems like a completely different realm.
They are, yeah. So, I think the comparison to Tesla comes from the fact that, well, one, they're trying to develop, battery electric vehicles, and two, in the name, right? Nikola Tesla, a former Yugoslavian, actually. That name comparison almost puts them two together. But really, I think why I'm bullish on Nikola is that they're not so much in the game to manufacture cars. They're in the game to really change the energy sector. And a lot of people are missing that point. Right now, when you buy a semi-truck from Freightliner, from Volvo, from Kenworth, the truck manufacturer sells the truck to a trucking company. And really, outside of maybe a service deal where they get to maintain the trucks, I would say 70% of the profit from that truck goes to the energy company. So for fuel costs, for diesel costs. And there's a few problems with diesel. One, it's expensive. Two, it's dirty and it's damaging to the environment. So I think what Nikola came up with the idea is to not only manufacture a truck that's battery electric, but also have a hydrogen powered truck that could go a longer range, which is really important when you think about over the road truck driving. If you're driving with a team driver, that truck is running pretty much 24/7. You stop to take your mandatory 30-minute DOT break, and then after 11 hours of driving, you switch seats with your team driver, and then they're driving the 11-hour leg. So in between, you need to have the ability to be able to refuel that truck within 30 minutes. Otherwise, you're wasting money, and that's why battery electric trucks don't work long range. They work short term or short range if you're looking at local deliveries and stuff like that. And then you can bring it back to its destination terminal, plug it in overnight, and charge it. But I think that's where Nikola has its advantage with the hydrogen. They want to not only make a truck that can be refueled within 15, 20 minutes like a diesel truck can, but they want to control that. So they would lease out their truck, and the service contract would be included. The fuel would be included. So this is a all-in-one package where a trucking company can say, okay, I'm going to buy this truck, and I know it's going to cost me X amount. Right now, I think it's $1 million over the lease of the truck, and I don't ever have to worry about my biggest expenses, which is maintenance and fuel costs. And I think a lot of people don't know about that, and that's kind of really where the trucking industry struggles right now is maintenance and fuel costs. So they're definitely going to be a disruptor, but I think the biggest thing they're going to be a disruptor in is going to be the fuel side. And if they can execute everything they're planning, which again that's questionable too. The CEO he's got a few failed business ventures. A lot of people don't have high expectations for him. But at the same time, I think, that's what makes it fun. It's always that one story of somebody hitting the big and that gets you excited. So yeah, long term, I think if they execute, it's going to be a great disruptor in the trucking space. As far as a direct competition to Tesla, outside of the Tesla Semi, I don't really see them wanting to go into. I know they have the Nikola Badger, the pickup truck, but I don't think they really want to go into cars because hydrogen cars have been around. They've been trying to manufacture, not just Nikola, but Honda and Toyota and all these big car manufacturers. I think the problem with hydrogen cars, and everybody runs into, is they're dangerous. You have to position the tank in such a way where if you're in a collision, the thing doesn't explode on you. So I think that technology is I think battery electric in cars is the way to go, and Tesla has hit on that, and there's no competition there. But in semi trucks, it's a little bit different because you can position the tanks in such a way where the tanks won't be damaged in a collision. And battery electric trucks are not the way of the future because one, they're too heavy, and payload when it comes to how much you can haul. That's where you make your money in trucking. You want to be able to take on that 40,000 pound load, but if your truck, if the gross weight of your truck is 50, 60,000 pounds, you're governed to 80,000 pounds. So you can't, legally drive a load more than 20,000 pounds at that point. And I think that would turn a lot of trucking companies off. And I think eventually, and this is just my opinion, again, this is not something that I know for a fact, but I think eventually either Tesla's going to have to develop some other type of battery technology for over-the-road trucks, or their trucks are just going to be kind of local route trucks that are kind of self-driving. But long term, I think there's no, at least what I can see and what all the research I've done, there is no feasible solution for over-the-road trucks outside of hydrogen powered.
Interesting. From your experience, and I don't know if Nikola has talked about this at all in their endeavors, but do you see, and this isn't even really getting into financials, but do you see automated truck driving taking over anytime soon? Because I know that's a big threat to a lot of the truck drivers, and it's pretty heavily talked about.
Yeah, so I don't see it being fully automated. Let's look at like airline pilots, right? So the plane can fly itself. The airline pilot, all the pilot does is, apply the thrust, the takeoff, and land for the last 30 seconds. So truck driving is a lot like commercial airplane flying. You're going down, you're cruising at, on the highway speed at 60 miles per hour for 95% of the time. And that's where self-driving trucks would be really efficient, but you still need the driver once that truck gets off the road and gets onto the local streets. One, if you ever kind of go to a warehouse location, no two warehouse locations are the same. You got alleys, you got to dock a 90-degree alley dock. You got to open the truck doors. There's a lot of stuff involved in the final 5% of you arriving at the destination where you need a person. But I think, yeah, it's going to become where, and even when I was in trucking, it was already starting with some of the automated stuff. There was a system called OnGuard where it's basically a cruise control system that's now out in cars, but you would have to, my company told me I would have to use this system 80% of the time, and they measured this. And basically all it is, I set the cruise control and the truck brakes itself, brakes when there's a car in front of me, keeps that 14-foot gap. And really all I'm doing is just holding the steering wheel and just kind of going down the road. So I think, yeah, automated trucks are the future. It's safer. Truck drivers, and this is no secret, but truck drivers work long hours. Thankfully, now the government kind of mandated electronic logs and kind of got the trucking industry in check. But before, when we were running paper logs, you could literally write, anything you wanted. There's people that were driving 36 hours and, illegally, but because there's no way to track that on a paper log, you've seen all these kind of accidents happen. And I think one of the ones that comes to mind is that Walmart truck, the Walmart truck that injured the comedian. But I think that driver was awake for like 30 hours or something like that. But yeah, I think automated trucks are going to make the industry safer. I think they are the future. And just like in the airline industry, I don't think they're going to take away from the job, because it's one of those jobs you still need somebody at the end of the day to maneuver that truck in tight spaces, to kind of open the doors, unhook trailers, drop trailers, do inspections, pre-trip and post-trip inspections on the truck to make sure the truck is safe to go. So yeah, long term, you'll still have a driver, but I think they won't be doing a lot of driving.
Interesting. I want to kind of go over, we've touched on little pieces of it throughout, but I want, if you wouldn't mind going over a quick kind of breakdown of your investment strategy right now, and maybe the different places that you're putting your money.
Yeah, absolutely. So as of this year, 2020, I had kind of set some lofty goals for myself, but I wanted this to be the year where I finally fully max out my 401k. So me and my wife's 401ks, both of them. So we're maxing out those at 19.5. And that's just in broad-based index funds. I have mine with Vanguard. She has hers with Fidelity. She's buys FSKX. I buy the Vanguard 500 fund. And then in our Roths, I have a set up Roths with Fidelity, and all I own there is FSKX in the Roths, and those are both being maxed out at the moment. So maxed out 401ks, both of our Roths being maxed out, and that strategy is on autopilot. I don't look at those accounts quite often. I don't worry about those accounts. A lot of it comes, off my paycheck before I even see it. And, in the case of the Roth, it comes out of my checking account on payday, and I don't even see that. So that's something I really want to lock down, because I think it's important to tax protect your money. And this can't be, understated that you're going to lose a lot of money in investing in fees and taxes. So if you can reduce those, which index funds do and retirement accounts do, it would be smart for you to do so. And then after that, so I'm maxing that out. I have 2 taxable accounts that I do. So I do the M1 Finance, which I show on YouTube, and I specifically created for YouTube. And then I have my Fidelity taxable account, where I just buy FXAIX, which is the Fidelity 500 index fund. That account is sort of a bridge account. I have a goal of retiring at age 40. I'm currently 30, so I have 10 years to go. And these retirement accounts that I'm maxing out, I'm not going to be able to touch those for another 20 years after I retire. So I have these bridge accounts, which are just taxable accounts, that I kind of put a goal to invest $10,000 in each of them this year, and hopefully up that the closer I get to that early retirement age. And those are 2 different accounts too. So the taxable with Fidelity, I just own index funds there. And then the taxable with M1 Finance, I own individual stocks. And that strategy is dividend growth investing, something that haven't studied for a long time. It's been only about 6 months since I actually got to understand dividend growth investing, but it's something that I'm a big believer in now. And I, even in a portfolio of 10,000, which is not very big to a lot of people, and it's, it's big to me, but it's not big to a lot of people. I've seen my dividends go from $50 a year, projected, to right now I'm at $380 projected in annual dividends this year. So, and that number is going to keep growing the more money I put in. And it's kind of like what we touched on earlier, having different strategies. And the third strategy now that I'm studying and trying to really get behind is growth investing. I think, at a young age, I'm not as young as I used to be, but the younger you are, I think growth should be a bigger part of your portfolio. And then as you get a little bit older, you need to balance that out and kind of blend it out with some value. But I'm still thinking, in some of these retirement accounts, I'm 30 and I won't be pulling the money out until I'm 60. I got 30 years, so I still have time on my side. So thinking about adding some of those growth funds that I talked about earlier, and not make them a big part, but maybe make it 20 or 30% of the portfolio, and the rest, in a broad-based index fund, and just let it ride, man. I don't want to look at it. I don't want to touch it. I don't want to worry about it. I don't care what it does, because I know once I open it up when I'm 60 years old, I'm going to have more than, $2 or $3 million in there. So that's the plan right now. That's the strategy. I also hold quite a bit of cash. I think this is where I differ from a lot of investors. Going back to Dave Ramsey thing, paying off debt has kind of, changed my life, but also cash has changed my life. So I don't use credit cards. I have a 2-year emergency fund right now that I hold in a CD with my local credit union. It's paying pretty good. It pays me 3.2%. So I'm not touching that money. It's kind of like, if you think about it, it's like a bond fund really, but with no risk, right? It's guaranteed. It's FDIC insured. I know my $50,000 in there is going to be at least $50,000, even if I break it early. So I hold a lot of cash there, and then I have another savings account that I hold somewhere anywhere between $10,000 to $15,000, which is not an emergency fund. It's really a emergency stock market fund, where if the stock market crashes another 20%, I can deploy that $10,000 or $15,000 very easily in the stock market. And that's really kind of all the different accounts I have and all the different strategies I have. And it's been really over the years that I've built that up. I've never really been a big believer in cash until recently of the stock market crash. And I'm like, dang, I wish I had some more money to invest. It's like everything is so cheap right now. But here I am, strapped for cash. And that's another thing too I want to kind of transition into is a lot of people might say, cash is something that you shouldn't hold cash. And I think if you study some of the investors, even look at Warren Buffett, right? He's sitting on a ton of cash. I get it. He's worth billions, and to be sitting on $12 billion of cash is not a lot, and someone who might be worth, 80, 90 billion. But when you think about it, really having that cash on the sidelines is a great strategy for people that invest in individual stocks, because that's how you're going to kind of have that performance, is when you can buy them on sale. And kind of the longer I've invested, the more I've kind of relied on holding a little bit of cash. I still believe dollar cost averaging into the market is the way to go, or even, that whole saying of time in the market versus timing the market, right? But I think if you have a lump sum amount of cash and you can deploy it at even you can dollar cost that, like I did in M1 Finance, right? The market started crashing in February, end of February. I was actually on vacation in Cabo. I was at the airport. I landed at the airport, and of course, the first thing I want to do is check my phone, see how my stocks are doing. And there's like a 5% dip, and I'm like, oh, what's going on? And I decided to, deploy $500. Next day, I'm, having a nice little tropical drink on the beach. I see another big dip. Now it's down 10%. Here's another $500, and I kept doing that pretty much throughout the entire crash, putting in these lump sums. I think at the end, when I did the numbers recently, I put in the 2.5 months where it's been kind of crashing, I put in $8,000. So I didn't do it all at once. I could have said, oh, 10% dip. Here's all my $10,000 I have here, put it in. I think that's not the way to go. You still want to lump sum dollar cost average down or up, whatever the case may be, because we can't predict how low it's going to go. Nobody had their, nobody had the vision that March 23rd, 2010 or 2020 is going to be the low point of the market, right? But if you deposited on February 28th, March 7th, March 20th, March 30th, guess what? You kind of bought all the way down, and you might have bought a little bit on the way up too, but you kind of got in the best of both worlds there. And I think that's important too. Even if you have a lump sum, spread it out and keep holding on to cash. Don't worry that it's losing its value. Try to keep cash in an account where at least it's keeping up with inflation. I know that's hard to do some days, especially today, but keep your cash somewhere where it's at least protected, it's keeping up with inflation, and have it ready to deploy at a moment's notice.
Yeah, I like it. I'm a similar situation as you in terms of my mindset on cash has changed recently. So I probably deployed my cash. Obviously, we can't time the bottom, but I got a little bit too antsy as we were 10, 15, 20% down, not realizing we were going down to potentially 30, 35. And so since we've slowly
Hmm.
recovered, I've been building up my cash position because it is still an uncertain market. And who knows, maybe we're going back to all-time highs. That's what it looks like. But for all we know, we're going right back down. So I want to be ready for it. But in our kind of last 5 minutes here, I want to get into maybe it can be financially related, but I want to talk a little bit about things that you're doing, whether it be reading books, listening to different podcasts. Obviously, I'm sure there's YouTube channels, but anything that you do outside of or inside the finance world just to continue to educate yourself.
Yeah, absolutely. I think books are my favorite way to learn. I try to read at least one book a month. Currently, I'm reading Think and Grow Rich by Napoleon Hill. But yeah, I mean, books I think are one of the best ways. Even if you're maybe a visual learner, it's important to kind of relax your mind. And I find that as a good hobby is just to sit down, get a cup of coffee, and read a book. And I feel like most of the investing knowledge that I get is from books. Yeah, there's podcasts I still listen to. The Money Guy Show. I don't know if you've heard of
Mhm.
them, or guys like Dave Ramsey, Chris Hogan. I listen to those guys kind of just for really just not even inspiration anymore. I feel like I'm in a different part of life, but just kind of learning and listening to different people's stories and YouTube videos. I've kind of stopped watching the bigger YouTube channels. Nothing against them, but being a YouTuber myself, I can kind of see there's sometimes an agenda that they push where the stuff they talk about is really for to gain more views, and it might not be the best thing for the average investor. So I've kind of gone down to the small YouTube community and guys like JMac Investing, guys like Ryan from the Independent Investor channel, Matt Money. Those are guys that have big portfolios, but they're still, I think, connected to their audience in the sense that they're not chasing views, they're not chasing YouTube fame. Their main goal is to educate people, and I love that about all those guys and all these small channels. I think I'm not trying to diss the big guys and the big dogs. They made it. Obviously, I want to be a big dog one day, but I just hope that you probably get better value out of a smaller channel because it's somebody who's still learning and who's still trying to engage the audience more in an educational sense than maybe somebody who's trying to make some money off the audience.
Yeah, I agree. And typically, you're going to find the bigger YouTube channels first when you first get involved and start watching those guys. But I've kind of noticed too that, I mean, it's all good information. I think that's the great thing about the finance community, other than the snake oil salesmen that we talked about earlier. But for the most part, I think they all
Yeah,
have good intentions, but it does just get a little bit redundant with some of those bigger channels because they have so many new followers all the time that they can kind of afford to do that.
exactly. Yeah, and just kind of like some of the stuff I'm seeing is stimulus check this,
Yeah.
cash this, and it's just like, man, come on, how much can you beat one topic? It's just like talk about something different because you have this big platform, and again, I don't want to make it seem like I'm hating on them, but you have this big platform, and you have this big idea to this big goal to educate people, and you're kind of doing it for the views and the search engine optimization and talking about stuff that people are searching. But hey, I guess, I mean, if they're doing it, it's working, and they're educating people. But at the end of the day, I think if you really want to get some value, you might be better off looking at some of the smaller YouTubers, guys who are in there grinding it out right now. Learning from them, you probably might pick up a lot more.
Yeah, I totally agree. Let's wrap it up here. Obviously, you can give any closing thoughts that you like. We have a few minutes, but I also want you to throw in there where people can find you and where they can follow you along.
Yeah, absolutely. So the YouTube channel is just Moki Finance. That's Moki. Finance, and I'm also on Instagram. Same thing, Moki Finance. Not as active on Instagram, I think, as I am on YouTube. Instagram is more like fun stuff. YouTube's the serious stuff. So if you guys want to, get educated, come on in, watch the channel, leave a comment, subscribe, all that good stuff. And then just kind of closing thoughts, just to wrap everything up. If you are starting your financial journey, whether you're you were like me and you got this pile of debt, or maybe you're a college kid who just graduated and you have no debt and you're ready to start investing. Just remember, stay away from things that are not going to make you money. Your biggest goal is don't lose money. So, do your research in what makes money, like those index funds that we talked about. And I'm not saying, start right away with the S&P 500 index fund. You can start however you like, but just make sure you do not lose money. And then number two is stay consistent. I think if you're a young investor, you really have a lot of time on your hands. You shouldn't be, jumping in and out of the market. Set up some kind of automatic deposit into your account, whether it's $100, $200 a month. It's going to go a long way for you versus somebody who's 30, 40 years old, because you're going to have this huge time horizon, and there's going to be so many more ups. There's going to be so many more downs, but guess what? None of that's going to matter, because at the end of the day, you will become a millionaire if you're consistent enough. So don't time the market. Don't try to get in on the next big thing. If you want as a little side, bet, that's absolutely fine. But be consistent, dollar cost average into the market, buy low cost index funds, and I just gave you the secret to becoming a millionaire.
There you go. They can thank you later. Well, thanks again for coming on, man. Well,
yeah, you can thank me later.
And they'll pay you out a little bit as well for your time. But thanks for coming on. We'll do it again soon.
For sure, man. Thanks for having me. I wish you nothing but the best. Love the podcast. Love the idea. I'll be following, and hopefully, we can get back in touch. 6 months or a few months down the road, and we can square off again and talk about the fun stuff that we like to talk about.